Good morning, guys. It is Wednesday, June 5th, 2024. This Bathrobe business. I'm George Yoganov. I got the coffee and I got the news, and I have been off for about a week. In my last recording, I mentioned how I was having in-laws come into town, future in-laws. I'm still engaged, but the in-laws were in town. They were staying with us, so that's why I couldn't really record in the mornings because I'm very loud when I record, is what my fiance says. So I'm back, and I've got a bunch of news stories I want to talk about. So let's just jump right into the news. So there's a couple of mini stories I want to mention, and then I want to get to the kind of meat and potatoes. So oil prices are down, and they're actually probably going to continue to fall and or drop below current levels. And this is because of OPEC plus. So this is an interesting story. Let me cast it again. I'm still learning the subtleties of this software, but I do want to show off this little story. So this is from CNBC, and it's in regards to OPEC plus. So uh, oil is currently below $73 a barrel. And OPEC Plus is announcing the fact that they're going to be dropping prices even lower. And the link to these articles are always in the description throughout the next 2 years. So this almost seems like it is a political move because OPEC Plus does include Russia. And these prices seem to be targeted at U.S. manufacturers and U.S. oil producers because below $73 a barrel, it becomes difficult for U.S. manufacturers to produce profitable oil into the market. So this seems like it's targeting directly into the United States market as a political move. So this is a joint venture, obviously, between Saudi Arabia, the traditional OPEC countries, and Russia. And so they're announcing that they're going to maintain low oil prices and increase production. Well, I should say they're going to maintain low oil prices by increasing production all the way through 2026. And this is probably going to cause oil prices to remain at current levels and then drop below. So this, I believe, is more of a political move than anything else, but it is going to be impactful. Why this is good is for obvious reasons is that it's going to cut inflation. Oil underpins everything in the market, and this is going to be one of those things that actually helps U.S. consumers, but does hurt U.S. manufacturers. Honestly, I'm okay with that because I'm not an oil manufacturer. So call me selfish, but that's how it is. I think individual consumers need some sort of break because I don't think inflation has been slowed enough by the Federal Reserve or actions taken by the federal government. Next story I'm just going to mention again in passing is just AI. So we talked about this story a couple of months ago, and it's finally happening that Intel is going to be producing an AI chip. So this is finally entering the market now. They're trying to undercut the current prices of obviously Nvidia, AMD. I don't know how effective this is going to be. We will see, but just wanted to throw it out there. And also, Qualcomm is going to be making its own AI chip as well. So I think all this does is just show the strength of the AI market is still very much strong and still going. Now, do I think it's overvalued? I think so. I think this bubble will pop sooner or later, especially when the valuations just aren't returning the profit that people expect. But I don't think this is happening soon. I think this is still an ongoing trend. Next story I want to cover is U.S. manufacturing. And this is where we start getting into the meat and potatoes of what we're talking about. So this is a story from Reuters, and it's directly in regards to U.S. manufacturing. So U.S. manufacturing activity, construction spending both fall. So this article is just from a couple of days ago. U.S. manufacturing activity slowed for a second straight month in May as new goods orders dropped by the most in nearly 2 years. Spending on construction projects slipped unexpectedly the month before. The latest indication that a gradual slowdown in the economy is taking hold. So this is actually an impactful story. And it is actually going to play very heavily into the next story I'm going to share. So we are seeing major weakness in U.S. manufacturing. And this isn't too surprising because we've kind of seen this trend for the last couple of weeks. Remember, we talked about import and export prices. We are seeing more imports coming in from China than we did a year ago, and we're seeing less exports coming out of the U.S. So this is showing weakness in the manufacturing market here in the United States. You can see my search history, groomsmen's gifts. I've been looking for stuff like this. And interest rates are still obviously remaining high. So this leads to the next story, which is payroll. So ADP released their private payroll growth this today. Now we're still waiting on the Labor Department on Friday. That is the more accurate measure, especially since there's been a major disparity, or I should say, difference between ADP and the Labor Department lately. Really, going back for 3 months now, but these numbers did come in below expectations. So ADP reported that companies added 152,000 jobs in May from the anticipated 175,000. Also, when you look at the details of this, construction is directly affected. So, trade, transportation, utilities, 55,000 new jobs, and construction only added 46,000, contributed. Construction only added about 32,000. So, construction is actually being reflected that it's showing down here, as well as manufacturing is also down from where it was a year ago. It lost about 20,000 jobs. So, this reflects the previous article as well. So construction lost about 20,000 jobs. Natural resources lost about 9,000. Information technology, 7,000. Professional business services lost about 6,000. And small business also saw a decline, with companies employing about 20 to 49 workers, down from 36,000. So there's definitely a weakness in the economy. I can actually vouch for this. So we are now currently hiring for a new position at one of our offices, and we posted an ad, and we're actually getting a very strong response, much stronger than we were getting even just a few months ago, or even just a year ago, especially a year ago. I'm getting resumes on a daily basis, and people are hungry for work. However, I do not see inflation coming down, because everybody that's coming in is still demanding a higher wage than what we were planning to pay for that position. We were actually already paying above market price. And this actually is reflected in this data, as well as in this article. It talks about that annual pay growth still maintains a 5% rate. So annual pay is increasing by 5% yearly. That's still above a 2% target of inflation, right? So we are still seeing incredible demand of people wanting more in wages. So this is why, obviously, this is the danger of inflation. As costs go up, people demand more money. As people demand more money, costs go up. So this is reflected in the data, and is reflected in my personal business. We are seeing that inflation is running high, and we are seeing that people are coming in and demanding a substantial amount more than what we are willing to pay for that position, especially when you consider the fact that we were already paying above market prices. So just that. Now, next story I'm going to talk about is the last story. This was, I think, the most important stuff, but the next story, I think, is also going to underpin U.S. manufacturing, so I think it's worth mentioning. So this was probably a couple weeks ago, we talked about the tariffs that are going to be imposed on Chinese EVs, Chinese green tech, etc., and how futile it's probably going to be. And here is the article that proves that. BYD plans to install a new plant in central Mexico. So BYD, the huge EV manufacturer in China, is going to be installing a manufacturing facility in Mexico, which means they're totally going to bypass those tariffs because of NAFTA. So there's free trade between the United States and Mexico. Now, could we reverse that, renegotiate it? Sure, especially with new administration coming and new blood, potentially. I guess I don't know yet. But either way, this could be renegotiated. But these deals are actually fairly complex, and it's not so simple that you could just go in and add a rider and try to change, because these are negotiated between the United States, Mexico, and Canada. It's a free trade agreement, so that means anything manufactured within those countries has the right to move between borders. So if China does this, and obviously they will, it's just a matter of time, these cars are going to come to the United States, undercut U.S. manufacturers, and we will see a manufacturing crisis, because U.S. manufacturing of cars is one of the strongest manufacturing sectors in the United States, right? U.S. auto industry is one of the, I would say, founding legs of the stool of the U.S. economy. It's not a small thing. And so this is going to play a huge factor into U.S. manufacturing. I don't think this is soon, right? This article is from April. It just came across my desk yesterday, actually. But it is going to happen probably within the next 3 to 5 years. This plant is going to be built, and then these cars are going to start migrating into the United States. So that's it. Those are the stories of the day. It's good to be back. I will see you guys probably tomorrow, right? So tomorrow's Thursday, so I'll see you guys back then. I hope you have a productive day.